Hey, welcome to today's podcast episode. I am your host, Abraham Emas. We're still on the financial management series, and in my previous episode, I discussed on capital budgeting, the concept of capital budgeting, and also the methods of capital budgeting, where we'll discuss about the NPV method, which is a net present value, and the IRR, internal rate of return. To our new listeners joining us for the first time, I say a big welcome to you all. This is Abraham's Ideas Podcast. You can hit on the subscription button and the notification bell so you'll be the first to access all my new episodes. So let's get into today's episode. In today's episode, I will be discussing on how to calculate the NPV and the IRR methods of capital budgeting. Net present value. Number one, NPV is the present value of future cash flows generated by a project, discounted at a specified rate of return. The formula for calculating NPV is in my previous episode. I discussed about NPV in my previous episode and gave the formula there and also gave the explanation to the formula. So if you haven't listened to the previous episode, you can do so as to follow up on the series. Let's go to calculating NPV. Enter the cash flow for each year in a column. Enter the discount rate in a cell. Use the NPV formula in a cell to calculate the NPV. Equal to NPV bracket rate, CF1, CF2, CFN bracket close. If the NPV is positive, the project is considered profitable and should be accepted. If the NPV is negative, the project is considered unprofitable and should be rejected. Number two, internal rate of return. IRR is the rate of return that makes the net present value of all cash flows from a project equal to zero. It is the discount rate at which the NPV of a project is equal to zero. To calculate IRR, enter the cash flows for each year in a column. Use the IRR formula in a cell to calculate the IRR. Equal to IRR bracket CF1, CF2, CFN bracket close. If the IRR is greater than the required rate of return, the project is considered profitable and should be accepted. If the IRR is less than the required rate of return, the project is considered unprofitable and should be rejected. So, the importance of discount rate. The discount rate is the rate of return that is used to discount future cash flows back to their present value. It represents the opportunity cost of an investment. It represents the opportunity cost of investing in a project. The discount rate is an important input in both the NPV and IRR calculations. A higher discount rate will result in a lower present value of future cash flows, making the project less attractive. A lower discount rate will result in a higher present value of future cash flows, making the project more attractive. It is important to choose an appropriate discount rate that reflects the risks and return characteristics of the project. Importance of cash flow forecasting. Cash flow forecasting is a crucial aspect of financial management that involves predicting the cash inflows and outflows of a business over a specific period. This process is vital for effective capital budgeting because it helps businesses identify potential investment opportunities and evaluate their financial viability. When evaluating an investment project, businesses must consider three types of cash flows. Number one, initial investment. Number two, operating cash flows, and terminal cash flows. The initial investment refers to the amount of money needed to acquire or develop the asset, including any upfront costs such as legal fees, licensing fees, and equipment purchases. Operating cash flows refers to the cash generated by the asset during its useful life, including revenues, operating expenses, and taxes. Terminal cash flows refers to the cash generated when the asset is sold or disposed of, including proceeds from the sales or any related tax consequences. Accurate estimation of these cash flows is critical to making informed investment decisions. Errors in forecasting can lead to poor investment decisions, such as investing in a project that generates insufficient returns or failing to invest in a project with high potential returns. For example, if a business underestimates the initial investment required for a project, it may not allocate sufficient funds to complete the project, resulting in delays or even project failure. To illustrate the importance of cash flow forecasting, consider the case of a startup that is considering launching a new product. The company's management team estimates that the initial investment will be $500,000 and the product will generate operating cash flows of $100,000 per year for the next 5 years. The terminal cash flow are estimated to be $250,000 at the end of year 5, assuming the product is sold for its book value. Using these estimates, the team calculates the net present value of the project, which is a measure of its potential profitability. Assuming a discount rate of 10%, the NPV is calculated to be $49,714,000, which is positive and suggests that the project is a viable investment opportunity. However, if the team's estimates are inaccurate, the NPV calculation may be significantly different, leading to different investment decisions. For example, if the initial investment is underestimated by $100,000, the NPV calculation would be negative, suggesting that the project is not financially viable. What are the risks and uncertainty? Risks and uncertainty are two concepts that are commonly used in finance and investment decisions. Risk refers to the potential loss or negative outcome of an investment, while uncertainty refers to the lack of knowledge or information about the potential outcomes. Capital budgeting involves evaluating and selecting long-term investment projects based on their potential to generate cash flows and create value for the company. However, these investment decisions involve a degree of risk and uncertainty, as future cash flows and market conditions are uncertain. There are different types of risks that need to be considered when evaluating an investment project, including market risks, credit risks, and operational risks. Market risks refers to the potential loss due to fluctuations in market conditions, such as changes in interest rates or exchange rates. Credit risk refers to the potential loss due to the failure of a borrower to repay their debt obligations. Operational risk refers to the potential loss due to operational failures, such as production disruptions or regulatory non-compliance. Risks can be managed through diversification and other strategies. Diversification involves spreading investment across different assets, industries, or geographies to reduce the impact of any single investment on the portfolio. Other risk management strategies include hedging, insurance, and contingency planning. In summary, capital budgeting is a process that involves evaluating long-term investment projects based on their potential to generate cash flows and create value for the company. This process involves a degree of risk and uncertainty, and different types of risks need to be considered when evaluating an investment project. Risks can be managed through diversification and other strategies. Accurate cash flow forecasting is important in capital budgeting, and there are different methods of evaluation, such as net present value and internal rate of return. So, this is the end of today's podcast episode. If you haven't subscribed yet, you can hit on the subscription button so you won't miss out on my new episodes. In my next episode, I will be discussing on financial planning. Thanks for listening. I'll see you in the next episode.